A 175-year-old glassmaker just quietly became one of the most important companies in artificial intelligence, and almost nobody noticed. Corning made the glass for Thomas Edison's light bulb, the screen on your phone, the fiber that carries the internet. For a century and a half, it has been a quiet, cyclical glass company. Then, in under 3 years, the stock went from about $30 to an all-time high of $212, roughly 6 times your money, because the market suddenly decided this old glassmaker is an AI company. Here is why: every AI data center on Earth is wired together with optical fiber, and Corning is the Western world's dominant maker of it. It sells the picks and shovels of the entire AI gold rush. So we rebuilt the methods of 5 of the greatest investors who ever lived and put Corning on trial. 5 legends, 1 company, 1 score. But first we do what they would do: we open the books. None of this is financial advice, it is how the great minds actually think. Corning makes specialty glass and ceramics no one else can: optical fiber for networks, Gorilla Glass for your phone, the glass in your TV, your car, the filters in lab equipment. And here is what changed everything. A single AI pod wiring up thousands of chips needs tens of thousands of fiber connections. The build-out is so frantic that fiber lead times have stretched to a full year. When you have to wait 12 months for a critical part, you do not shop around, you sign a long-term deal, and 3 of the biggest names in tech just did in a single year: Meta up to $6 billion, Nvidia 3.2, and on June 8th, Amazon. The result: Corning's optical division grew 36% last quarter, while its 4 legacy segments barely moved. AI is doing all the heavy lifting. The old glassmaker has a brand new engine. And Corning is no niche supplier. It is the Western world's dominant maker of optical fiber, with factories on 3 continents. When America builds AI, it builds on Corning's glass. And demand is so far ahead of supply that lead times stretched to a full year. That backlog is exactly why the hyperscalers sign multi-year deals. You cannot simply order more fiber tomorrow. So is this a genuine reinvention worth owning, or a cyclical glass company priced like a tech stock at the top of a boom? Don't guess. Run the numbers. Here is how an analyst actually reads a re-rating like this. The numbers, one by one. Start with the engine. Optical communications grew 36% and the hyperscaler slice grew 61%. This single division is the cause of everything else: the moat, the re-rating, the whole story. And the moat underneath it is the real thing. Corning's edge isn't a product, it's a process. Fusion draw, vapor deposition fiber. Secrets baked into the factory itself, protected by 12,000 patents. A rival can't license its way in, it would have to rebuild a century of manufacturing. And critically, the growth is turning into real profit. Corning hit its 20% operating margin target a full year ahead of plan, and its return on capital finally climbed above its cost of capital. This isn't a low-margin treadmill, it is genuine value creation. And unlike the other AI bets, the balance sheet is a fortress. Debt is a comfortable 1.9 times earnings, interest is covered 7 times over, and Corning has paid a dividend for 42 straight years. This is a real, cash-generative company. So where's the catch? The price. 84 times trailing earnings, 52 times forward. The gap is the market betting profits will sprint to catch the price, and they are growing 70% this year. But make no mistake, you are paying up. On the cleanest valuation gauge, enterprise value to earnings, Corning trades at 40 times. A normal industrial is 18. Corning's own 10-year average is 11. The market has stopped pricing it as a glassmaker and started pricing it as AI infrastructure. And price to book tells the same story. 13 times versus 2 to 4 for an industrial. If that multiple ever reverts to normal with no change in the business, that is 60% of downside. The re-rating cuts both ways. Stack it against its peers. Versus Amphenol and Coherent, Corning has the deepest moat and the healthiest balance sheet, real margins and a dividend, but it also carries one of the richest multiples in the group. And here is the risk hiding under the brilliance. This entire story rests on 3 customers: Meta, Nvidia, Amazon. If AI spending pauses the way it briefly did in early 2025, a stock priced for perfection can fall as fast as it climbed. Management even put a number on it. Its springboard plan targets $30 billion of revenue by 2028, 40 by 2030, and it has already beaten and raised that target 3 times. The growth is not a hope, it is a guided commitment. And underneath the hype is a real, cash-generative company. A dividend covered at 44% of earnings, paid every single year for 42 years. The yield only looks tiny because the stock tripled. So the question this episode turns on isn't whether Corning is a great company. The numbers say it clearly is. It's whether you are paying too much for a greatness everyone can already see. Let the legends decide. Philip Fisher, the father of growth investing. He hunted companies with a deep, hard-to-copy technical edge and a long runway of demand, and he refused to sell them over a high price.
Fisher's model is thrilled. This is the rare company he dreamed of. Decades of process, know-how no competitor can buy, a brand new wave of supply-constrained demand, and margins that are expanding as it grows. His famous 15-point checklist would light up green. A genuine technology-led, expanding margins, management beating its own targets, and years of demand ahead. This is the textbook case he wrote the book about. He would do his scuttlebutt and find customers begging for more fiber than Corning can make. To Fisher, that is the definition of a long runway. He shrugs off the multiple. He scores it an 8, the highest mark this board has given.
An 8, the strongest score yet, but the next legend cares about one thing above all, the price you pay. Benjamin Graham, the father of value investing, never pay more than a business is conservatively worth. Demand a margin of safety so you survive being wrong.
Graham's model gives Corning real credit, more than it gave the others. This is a profitable company with hard assets and a dividend paid for 42 years. It is a genuine business, not a story. He would concede this is the finest business this board has judged. But quality, he insisted for 50 years, is never a substitute for price. They are two separate questions, and on price, his answer is no. But 84 times earnings and 13 times book, that is no margin of safety, it is a tech multiple on a Glassmaker. A wonderful business bought too dear is still a speculation. He scores it a 3.
3, the value hawk respects it but won't pay up. Then comes the man who almost never likes anything and whose verdict here is the real surprise. Charlie Munger, Warren Buffett's partner, the man who sends most companies straight to the too-hard pile, demanding a moat almost nothing on earth actually has.
And for once, Munger's model is genuinely impressed. This is the kind of moat he spent his life describing. A process competitors cannot copy, a near monopoly in domestic fiber, decades of accumulated know-how. An idiot could run it, he might say, and it would still do fine. He spent decades warning that almost nothing on earth has a real moat. A process secret baked into a factory that a rival would need a decade and a fortune to copy. That is the rare exception he actually believed in. This is no commodity, it is a fortress. His only hesitation is the same as always. He hates overpaying even for greatness, so he won't call it a screaming buy, but he tips his hat. He scores it a 6, his highest mark on this entire board.
A 6 from the great skeptic. That tells you how real this moat is. Then comes the man who knows exactly what kind of company this used to be. Peter Lynch, 13 years beating the market. His gift was knowing precisely what he owned, and he would recognize Corning instantly, for most of its life a classic cyclical.
Lynch's model sees a cyclical that may have changed its stripes. The optical business isn't bouncing on a normal cycle, it is locked into multi-year contracts. That is far better than the boom-bust fiber of the past. He would run his 2-minute drill, a 175-year-old company suddenly growing like a startup because of one product the whole world now needs. He would love that story. He would just check where we are in the cycle. But his rule for cyclicals never sleeps. Are you buying near the top of the capital spending wave? A growth multiple on a company tied to hyperscaler budgets makes him cautious. Great company, late-ish entry. He scores it a 5.
A 5, the swing vote, one voice left, and he lives in the gap between a great company and a great price. Howard Marks, the master of risk and cycles. He asks not just is it good, but what is already priced in and what happens if the story cracks.
Marx's model sees a wonderful company and a crowded trade. When a business this good is universally loved and trades at 4 times its normal multiple, the quality isn't the question, the price is. He would remind you the riskiest moment is not when a stock is hated. It is when a great company is universally loved and everyone already owns the story. That is exactly where Corning sits. And the whole thesis leans on 3 customers and a capex wave that has paused before. His question, as always, where is the margin for error? At 40 times earnings, with analysts already calling it overvalued, there is little. He scores it a 4.
A 4, so the playbook closes. What does the board decide? 5 legends, 1 company. Fisher 8, Munger 6, Lynch 5, Marks 4, Graham 3. The combined great score for Corning, 5.2 out of 10, the highest score this board has given any company yet. And that is the story. For the first time, even the skeptics admire the business. Munger tipped his hat. The debate was never about quality, it was only ever about price. Here is where they agree. The moat is the deepest any company has shown on this board. The AI demand is real and supply constrained, and the price already reflects nearly all of it. And here is the fault line. Fisher says a moat and a runway this rare are worth almost any price. Graham says no Glassmaker is worth 13 times book. Munger, remarkably, sits closer to Fisher than he ever has. A 5.2 says this: Corning is the best business this board has judged. It is also the one where the market most agrees with you. The opportunity isn't a secret anymore, and that is exactly why the legends hold something back. So watch one thing above all: the customers. As long as Meta, Nvidia, and Amazon keep building, Corning's fiber sells itself. The day that capex wave slows, this stock learns how far a tech multiple can fall on a glass company. So what is your score for Corning? Great business or great price already gone? And which company should the board judge next? Tell me below. This was the Greats Playbook, where history's greatest minds judge the companies of today. None of this is financial advice. These are AI models of public investment methods, not the investors themselves. Study the greats, then think for yourself.